Few things that we need to talk about today coming up. We have PCE. Okay, these are the numbers that the Fed used to judge inflation and ultimately set the plan forward for what they are going to do. Let's get into some of the news. Also, I want to talk to you about why Ethereum could see more downside. Let's have a look over here. All right, okay, jumping in. Right, so today we have core inflation from Canada. This is a really good one because it's typically very, very similar because the spending habits and also the way in which both countries get their stuff. You know, they get them all shipped in from the same place. So generally they eat the same things, they drink the same things. And it gives us a really good indication in Canada as to what the US is going to be like. Typically, they're both very, very similar. But then just looking over the next 7 days, okay, so this is, that was today, that's Canada. Tomorrow we have GDP growth rate. This is going to tell us, are we in a recession? Now, if you remember, the first 2 months of the year, we had 2 quarters of negative GDP growth. And then we had GDP growth in the third quarter of only 0.6%, which is not a lot, but it is still, kind of a little bit of something. It's a little bit of something, which is okay, so we don't mind that. And now, then the big day on Friday, core PCE numbers and PCE. Okay, so previously it was 5. We're wanting this inflation level to come down. PCE very, very similar to CPI, but PCE is what the Fed looks at. So when I show you the summary of economic projections, which is what we're looking at right here, we can see that the Fed fund rate is looking to be 5.1 by the end of 2023, sorry. If I go on to 2022, this is what they had predicted previously, 4.4, but they updated it recently. I did a full video on this. If you do want to find out, I think it was called the Fed's Master Plan, something like this. Go have a look. Really, really good video. Also, like the video right now, the one that we're currently on, just because then it gives us a little bit of an idea as to what you like, and it helps us push the channel a little bit further. So if you do enjoy the content, it's really much appreciated. But anyway, so we're moving into 2023. What are we looking at? So we want to be seeing these PCE numbers, okay, and core PCE, because this is exactly, like I said, what the Fed are going to look at and what they're going to base their opinions on. So we're forecasted to move down to around 4.7 for core. And as you see, by the end of 2023, we want that core to be down by another 1.2%. So gradually coming down, which is good for the markets. We really like that. Now, there's one thing that I do think is going to be a major issue, probably this week, but especially in the next couple of weeks, okay? And this is labor data. So as we look through here, one of the key elements is looking up the unemployment rate, okay? So the end of this year, we're looking at having an unemployment rate of 3.7% of the US, okay? 2023, we're then looking at 4.6. 2024, we're looking at 4.6 again. And then 2025, I believe it will start changing, coming down slightly to 4.5. Okay. But the whole point is we are looking at unemployment being a lot higher. Right. Now, we know unemployment is super, super important. It always moves the market. We get the unemployment reports coming out on the first Friday of every month. And so we always see a big move in the crypto space. Now, I just want to make this relatively quick. Okay. When the labor data is collected, you have two different ways of doing it. Okay. One of them is that someone from the government calls you up and says, "Hey, mate, do you have a job?" Yeah, I've got a job to. Okay, cool. You're one person, you have one job. Okay. Even if you have 3 work from home jobs, you are still classed as one person having one job. So this is one set of data. The second set of data is when the government goes to businesses and says, how many people do you have on the payroll? And obviously, let's say we're going to take Google and Microsoft. If you work for both Google and Microsoft, one, you must be balling, well done, but you're going to have two jobs. So when they call you up and they go directly to the citizen and say, hey, have you got a job? And you say, yeah, I've got a job at Google. No, you're one. Okay, you're one. So you get counted once. Then if you go to each separate employer, you call Microsoft, oh yeah, I've got this guy, his name's Ben, he works. And if you say Google, oh, I've got this guy, Ben, he works. Then you've then been counted twice. Now imagine if they're lower paying jobs, you might have two jobs, three jobs, maybe even four jobs, one on the weekends, one in the mornings, one in the evenings, whatever. And so you get counted numerous times. This is leading to a massive discrepancy in the job market data. Okay, and I just want to find the exact comparison. Let me just do this because I know what the number is. 1.2. No, it's 2 million, isn't it? Let me just go million. A million. Right. Okay. So here. So look, by the numbers, that isn't what happened since March. Employers have employers reporting having added 2.7 million jobs. Okay. So when the government goes to the employers, they say 2.7 million jobs, but only 12,000 more people in the household, where they call you up at home, have reported being employed. So there is a massive discrepancy. Now, the Fed are going on this data that they get from the employers. So 2.7. So what they're assuming is employment is so much higher. And that's why everyone is stressing about this number here, about getting this unemployment rate really high, because they're like, shit, we need to tighten. We need to do loads of work to make sure that actually this 2.7 million jobs that have been added since March, we need to get those down. If the real number, and I don't think it's going to be 2.7, and I don't think it's going to be 12,000 either, but I think it's somewhere in between. Now, if the Fed are only looking at the 2.7, they could end up squeezing the market really, really aggressively, which is what they're currently doing. And if the unemployment is in fact much higher and the jobs market is much weaker, then we could see over tightening and really a case for us to actually, begin untightening, shall we say. So I wanted to kind of drop that in there. This is something not many people are talking about it right now. And I know that, especially in crypto, obviously, because to be honest, I think a lot of people in crypto don't focus on some of these things. But anyway, and I will jump into crypto now. I wanted to mention just the fact of the recession. Obviously, core PCE numbers coming out that will impact this whole discussion around a recession, which is pretty much guaranteed, to be honest. I mean, I think it absolutely is. But I wanted to highlight this. When is a bear market usually over? And I think that we are going to see a correlation. S&P bear market, Bitcoin bear market. I do think they are going to be very, very, very linked, because at the moment, the reason why I think Bitcoin is still linked with, or correlated to the likes of S&P or Nasdaq, and I know it's not an exact correlation, but the whole market is on a risk-off mindset. So this is why we're not seeing, the Nasdaq rally. We might get a small, bear market relief rally, but we're not seeing that. So anyway, when does a bear market usually end? 3 to 6 months after a recession has begun. We're unsure at the moment when this is going to happen. People are thinking early stage 2023. So we might still be in this bear market. Well, it might end around 3 months after the beginning of, let's say, Q2, for example. Interest rate hikes have concluded. We're still increasing. Unemployment raises by 1.2. We haven't done that. ISM manufacturing PMI is below 50. I believe it's like 51. And EPS estimates have declined by more than 10%. Now, I don't have the data on that. So if we kind of look through here, and we can, there's a lot of technical data in here, to be honest, and I'm not going to go through all of it. But yes, I just wanted to highlight this. Finally, the market does not pass the eyeball test. The market continues to behave like a bear market, with ripping bear market rallies in a continued downtrend. So we are in a continued downtrend. And this is even falling into or carrying over into the likes of Ethereum. We're bouncing above that 1.2K level. Look, as you see just here, only slightly only slightly. Holding quite well though, really holding quite well, which is good. It's good to see, but also, come on, do some pumping for me. That's what we want. But demand for leverage buying remains absent in Ethereum despite the bounce above 1.2. Now we can see this downward trend. The most important part though that I wanted to highlight is options trading. So the delta skew indicates after December 15th from a fearful 14% drop against the protective put, options to the current 20%, the movement signaled that options traders have become less comfortable with downside risk. In a nutshell, both options and futures markets point to pro traders not trusting the recent bounce above 1.2K. The present trend favors Ether bears because the odds of the Fed maintaining its balance sheet reduction program seems high. This is quantitative tightening, reducing the bill by $90 billion each month, which is destructive for risk markets. We're going to, as long as we see quantitative tightening, we're going to have this. So people just don't want to, they don't want to offer downside protection. We're not seeing this level of support, and the longer that we're in these bear markets, the longer we're going to see this. Now that's institutional buyers. Looking at like just normal retail buyers, we can have a look here. We can see that there is a general trend increasing. So the shrimps, the prawns, the crabs, the whales, generally all increasing their bags at the moment. Maybe not so much the whales, but we can see, yeah. So look, over 100,000 Bitcoin actually gone down. So here, so it's only really from like 1,000 up to 1,000 Bitcoin. Everyone is kind of, increasing their bag. So which is good to see. It's really good to see. The whales not so much, which is a little bit concerning. And especially, like I said, the institutions and whales are exactly the same person. But some good data to kind of see. I think a lot of people believe in Bitcoin at this price. I think the really big whales are probably just day trading it. But like I said, as part of a ginormous financial firm. And another thing this week, Coinbase CEO said financial regulations should be limited to centralized actors. That I agree. I think you should regulate the likes of Binance, regulate the likes of Coinbase, because that's what's going to bring, I guess, you can't regulate money. And I don't think crypto itself should be regulated, okay? But you can regulate the people who manage money, for example. So just in the same way, like JP Morgan have to be regulated, but they trade in cash. You can't really regulate cash. It's just cash. It just is what it is, So I think this whole regulating of blockchains themselves, I don't think is really going to work. Maybe you can regulate the centralized actors, and I think it's going to be bad. Okay, at first when regulation comes, it's going to poo on the market, but I think eventually it will lead to mass adoption. And finally, just US Binance is going to acquire Voyager's assets for $1 billion, which I think is actually kind of nice. I do think it's quite good. I also heard that they are going to have potentially reopening relatively soon, which is good. We want people to be able to take their money out, but also Binance, coming in. Yes, they're spending $1 billion, and the question is, do they have that money? I know everyone's been unsure. Does Binance have that money? The French accounting firm that they were working with for their proof of reserves is now no longer working with crypto firms. That's a bit sketchy. Should they be spending $1 billion right now? I don't know. Long term, it's a great plan because I guarantee they're getting these well undervalued. They're probably getting, buying them for 20 cents on the dollar. So they might be buying $5 billion worth of assets for only $1 billion. So that could be really good. But also, if they're all illiquid, that causes issues, and especially if there's a bank run. But anyway, that was everything from me. I've kind of ranted on here enough. If you have any questions, obviously drop a comment down below and also like the video. Thank you very much for joining, guys. See you later.